All right, good morning, everyone. It is Friday. We are live today. At least I have my mute button off. Yesterday, I started a live and I was muted for like a few minutes until someone let me know. But at least our guest showed up on time today. Everyone was late yesterday. So thanks for tuning in, everyone. We got Jeremy Taggart, Pittsburgh rock star agent, broker, house hacker. So what's up, Jeremy?
What's going on, Mark? How's it going?
Good, good. Harrison's running a little late. Harrison is also pivoting to the Pittsburgh market, but maybe before we jump in, so I know Jeremy's a Pittsburgh Steelers fan. So what'd you think of your first round pick last night?
I thought for sure we were going QB, but maybe they have PTSD from the Kenny Pickett selection a few years ago. So, I'm not surprised. I even thought we were potentially going to go running back with Henderson still there, but I think their Najee Harris thing, a little bit of PTSD as well. So, sticking to their roots and going with the trenches makes sense, but we'll see how it plays out.
Yeah, I'm not too thrilled about the Bears pick. I mean, I think he's a good player, but at 10, I'm kind of surprised.
I
But
thought Warren was going to be the first one off the board for sure.
yeah, but I guess supposedly, I mean, I don't know. This guy fits Johnson, the coach's style better. So we'll
Yeah.
see. Yeah, we'll
I think
see.
he's more of a true receiver of a tight end, like more of the wide receiver
Yeah,
mold
yeah,
compared to Warren, who's maybe more of a true tight end, I guess you could say, as far as more balanced, but only time will tell.
yeah. We'll see. Or at least we got a quarterback. But Dennis is here. He's a Steelers fan
You,
too. He said he's
do
worried
you
about their
though?
quarter. Of course. Yeah. Okay, we can talk about
I
that
don't
after.
know.
Let's get into the Pittsburgh market real quick. But as people may not know, like Dennis says, Jeremy Tagline, you're like a seven-time house hacker, right? So we do have Jeff and Suleika in the one rent at a time community. I believe they're at nine though house hacks. So you're
They got me
close.
beat.
Yeah, they do. But you're killing it out there. So I think there's a lot of people in our community starting to pivot or even start to look at the opportunities in Pittsburgh. So maybe you can talk about that or what kind of deals you're seeing coming through. How's the Pittsburgh market looking right now?
I think Pittsburgh's unique because the single family side, like supply's starting to go up, but it's still pretty tight. So there's still more demand than supply on the single family side. I think that's just the whole Northeast, Midwest, though, affordable markets. And then the multifamily is kind of interesting because it's more of a national game now with investing. The out of state investment has kind of made it to the point where there's so few markets left that you can get any sort of positive cash flow. So there's still a lot more demand, I would say, than supply on the multifamily for that reason. I think like Pittsburgh, Ohio markets, Midwest in general, it's kind of like everybody's flocking to those markets to the point where you can still get positive cash flow now, but I don't really know how much longer it's going to last. Just because I'm seeing the trend, like there is so many people each and every year, the percentage of our clients that are out of state versus local keeps getting more and more skewed towards out of state. I think for that reason. So it's interesting to kind of see it firsthand working with the out of state clients. But as of now, I mean, you can still get positive cash flow. We're seeing specifically multifamily that most all the neighborhoods are still hitting 1% rule or higher, unless you're like in the A class areas. Those are kind of overtaken by non-investor house hackers at this point. I know we touched on that a little bit before, but most other neighborhoods still make sense to the point where the multifamily is still solid here. And we have a lot of like burrs and flips that are still doable here. That works in this market because the price point's a little cheaper. The rent to price ratios are better. So you can still pull off a burr without having to leave a ton of your own money into it. And then obviously flips still work in pretty much most neighborhoods here.
Flavio has a question. He says, "What's the price range for cash flow?" So, is there like a sweet spot you think maybe for single family homes and even like small multis?
Yeah, single family is getting tougher for sure. But as long as you're under About 200,000, I would say on the high end, you can still get positive cash flow with a 20-25% down payment on something turnkey. It won't be a lot, like it'll support itself, maybe cash flow 1 to 200 bucks a month if that, but it will be positive cash flow with your standard 20-25% down, but you just kind of have to stay under 200. Once you go above 200, it's the rents tend to not keep up to the point where that rent to price ratio is dipping below 1%. And the multifamily is a little more favorable. So the same neighborhoods where a single family would be above 200, you can still get the 1% rule on a multifamily. So that's typically what I recommend to clients, especially if they're focusing more on cash flow, is turnkey or close to turnkey multifamily. Those we got some C class areas, you can get stuff as cheap as like 50, 60,000 per unit, upwards to on the high end, I would say about 125,000 per unit is where the cash flow starts to tap out. Same concept there. Once you go above 125,000 per unit in general, that's when the rents tend to not keep up with the prices. So 50 to 125,000 on the multis, and obviously that can go up as many units as you want. Essentially, I think the cash flow actually starts to get better as you get into the 5+ unit space because that's not quite as saturated. You're having more just strictly investors buying those, whereas in the B class areas, the 2 to 4 units, you're starting to get some house hackers competing with the investors driving those prices up. So those are kind of the price points. And then in terms of rent to price ratios, it depends on the neighborhood you're in. Multifamily in a B class neighborhood close to downtown, that's probably a little over the 1% rule mark, right around 1%. Whereas you get into kind of the C class areas, little farther from downtown, tertiary type neighborhoods, those are creeping more towards like 1.5 rent to price ratio. And even some of them, if you get like strictly just cash flow neighborhoods, turnkey stuff, you can get even kind of in between the 1.5 to 2% rule. We're not really seeing too much of that, but I have seen it. And these are neighborhoods that are going to be more management intensive. They're probably not going to appreciate a ton long term in both price point and rent growth. But if you want cash flow, I mean, we do have that as an option as well. So kind of a decent variety as far as the cash flow type neighborhoods goes here still right now.
All right, I want to say good morning to Jovi's here. He's a Packers fan, so he's a nightmare to me in the comments. Sarah Garrett's here. She was one of the speakers at the One Rental at a Time event, so thanks for tuning in. Let's see, Flavio's here. Hyder tuned in. He says his algo must be messed up. He's been watching truck video. Okay. And I think I also heard Brian, who was having, I don't know if people tuned in to the last live you were on. You know, we talked about Brian, who's in the ORAC community. He was working on, was a duplex or quad? The one he was having issues with the zoning slightly.
That's a fourplex.
Fourplex.
We
Okay.
got the clear on that. Looks like we're
Yeah.
closing Monday.
Yeah.
So
That,
that's a great deal for cash flow here, the one he's buying.
yeah. You touched on working with a lot of out of state investors. Do you see a lot of them coming, like they're not rookies in a sense, like they've been investing in other markets, but like you're saying, they're pivoting because they're finding it hard to make deals work in other areas, and that's why they're coming towards Pittsburgh.
Yeah, a lot of the clients own stuff where they live, especially if they bought it previously. So it's kind of a that concept. They're going where the cash flow is at this point. And even people that were buying in kind of some of those hot markets during COVID, those are now to the point where they've dried out basically. So it's those people coming into Pittsburgh a little bit now too. So it's like I said, it's been interesting to see the dynamic shift, but it just seems that there are once interest rates went up, a lot of those markets that maybe were slightly positive cash flow at that point, they kind of then turn negative, at least if you're putting your standard 20-25% down. But now it's kind of shifting to the more affordable markets, which I think you might even start to see it a little bit on the owner occupant side, single family as well, just because like people on the coast, I've even started to see it a little bit. If they want to actually own a house, they're willing to move to cities like Pittsburgh or some of the Ohio cities just because they can do that in those cities, have a decent quality of life, own a house, especially if they're working remote. We're starting to see some people kind of make that decision as well. So I think these affordable markets in general, like think BP refers to them as like the Great Lakes type region. I think they're going to be kind of the cool markets here in the next 5 to 10 years, kind of like the Sun Belt was during COVID and out west a little bit.
Yeah, that's why I'm glad I'm looking forward to the opportunities because I feel like Pittsburgh, and they talk about it's one of those last big cities, I guess, that is still more affordable to purchase in a sense than rent. So it still hasn't flipped. It's like one of those last markets where people are still buying because it actually makes sense compared to renting. And once that flips, and that's when the market is kind of really gonna take off for investors, I think.
Yeah, I think percentage wise appreciation, I think like the cheaper markets are they're gonna have a higher percent appreciation compared to kind of the hot markets during COVID, which are starting to turn negative now, which is interesting. So we'll see how that dynamic plays out.
Yeah, so Hyder says, I got a flooring replacement job today. He's rather be retired, but he didn't start his real estate investing journey soon enough. So I think a lot of people, myself, Dennis, I think Flavio's on the older side, and we probably maybe went down the traditional path. And just remind everyone, you're on your seventh house hack, and I forget, are you 30 yet?
31. I'm
Yeah,
old
so
now.
oh, you're old now. Okay,
Yeah.
so yes, Hyder says opportunity zones are the path of least resistance for investors. So maybe you can kind of touch on Brian. I don't know if people know Brian, but he's in the comments a lot for the Zuber and Dion's videos. But Brian just, or Monday, you said he's probably going to be closing on a fourplex. And what kind of issue was he facing on that one?
This one was super bizarre. So it's a 4 unit building, like set up as a 4 unit, nothing weird about it. And I guess when the appraiser did the appraisal, they put on the appraisal that it's technically in a R2 zoning area, so that if it were to be burnt down, you could only rebuild it as a duplex, which is really weird because I've never seen that. And it's in McKees Rocks, which is a borough outside the city. So normally those boroughs are they're pretty laid back when it comes to like zoning stuff. They aren't super strict about it like the city of Pittsburgh itself would be. So I just thought it was really weird, but the lender, the fact that the appraiser put that on the appraisal, they didn't want to lend on it until they got something from the borough that said if this burns down, it can be rebuilt as a fourplex. And going back to the borough being kind of lackadaisical on zoning and stuff. They just couldn't get a hold of them, never responded to us on it. I think they were just kind of dodging it. So at that point, the sellers were like, all right, we need to make a decision on this. We can't keep waiting. So Brian was working with a mortgage broker who had access to other lenders. So he just shopped it to another lender. They were fine with it as it was because it's zoned with the county as a 4 unit and everything. So just had to shift lenders and now we can finally close on it. I think that the seller, they had issues with it potentially before as well. So it's more of just the lender specific preference thing, but it's nothing to the point where like there's other options for lending. It was just kind of working through that slight roadblock. But you always run into weird stuff like that. Like we deal with it a lot in the city limits too. I just dealt with a couple. Oe actually, he's still going through that one. Um, kind of a different in a little bit of ways, but similar type situation there. So I think it's like just knowing that there are all these intricacies with the different municipalities that you sometimes can have to make sure you do your due diligence on, and they could pop up at any time with any of these deals, especially on like the older homes and stuff.
Yeah, so Jeremy mentioned OE. If people don't know, he's been at both One Rental at a Time events in Vegas. He's Orange Juice Properties on social media, but he's been working with Jeremy also. And I think Zuber mentioned him maybe a couple months ago. He is the one, I believe, that got a disrespectful offer accepted. I believe the listing was probably sitting for over a year, maybe. Maybe the initial list price was like 400K or three, but he got it for like a like 40% off or something, I believe, off a list price. So, but yes, always doing cool stuff out there. So go check him out. Also, Chester's here. Yeah, Andy says I remember 31 barely. So, yeah. Hyder says chased that appraiser out of town with tar and feathers. Yeah. So what else are you working? I know Brian also showed me that fourplex. I think it was a fourplex you sent him. I think he was saying it's kind of like a 2% rule possibly
Oh,
for
in
now.
Knoxville, yeah.
Yeah, yeah. So is that something like you were saying? Some people, if cash flow is what they're looking for, there's properties like that, but the area, like you said, it might be a little bit more work for you or a manager.
Yeah, it's kinda that's what you have to decide as an investor, especially out of state, is the more cash flow friendly from day one a property is, generally, in most cases, the more management intensive the area or building itself might be. And there's very like caveats to that as well. Like a lot of these neighborhoods in Pittsburgh, there's nice pockets. Like even if it is generally kind of a lower income neighborhood as a whole, there are sections that are nice within those neighborhoods. Like I own some myself to the point where if the block it's on or the couple blocks around it are nice and the houses are nice, well maintained, in decent shape, you can still get pretty decent tenants. So that one was kind of skewing towards that, but you still have the risk that like even that section could turn the other way and kind of fall victim to the rest of the neighborhood if it kind of gets mixed in with that. So there's risks involved with it, but it can be a way to kind of navigate, cheat the system a little bit to kind of get those cash flow numbers you want. But knowing that you might have to kind of weed through more unqualified tenants until you get a qualified one, you may have to deal with some more random headache type stuff to get to that cash flow. But there are options like that. Like that one was basically a 2% roll deal. Like I think it needed a little bit of outside work and maybe the roof was older, but outside of that, it was pretty turnkey, like very solid, nice setup as a fourplex building. So if someone was willing to kind of take on those quote unquote risks, then that could be a great way to kind of get the cash flow right off the bat, but knowing that what goes along with it. I think where people run into issues is they buy deals like that and they think it's going to be mailbox money, which it real estate in general is not that in any way, shape, or form, despite what people might think. And then they run into issues, and especially if they're newer investors having, I would say, unrealistic expectations of third party property management. Like if they've never managed a property themselves, they don't really know what goes into it. So expecting to buy a 2% rule deal in a borderline neighborhood and just collecting paychecks every month is just not going to happen. So you do see more turnover when people buy those buildings that aren't expecting it. You'll see them listed on the market a couple years later because the management is just bad, if they picked a bad property manager or anything. And it's just sometimes tough to get third party property managers on board as well with the lower class neighborhoods. So that's kind of plays a role as well. Like me being, say, if I'm local, self managing something, that's a lot different than relying on third party property management out of state. So those are kind of the factors that have to be weighed with out of state investing. So I kind of tell clients that there is a lot more to it than on the surface, basically.
We got Hugo here, Stay Winning Pod. So good morning. Go check him out. Yeah, I finally hit the 800 subscribers. So anyone else tuning in, go subscribe, please.
When you
Trump,
hitting 1,000?
hopefully soon. It's a journey. Well, Hugo putting Trump 2028 might help get a few subscribers today. But Chester does have a question for you. He says, "How is flooding in and around Allegheny County?"
What is that?
Chester asks, or Wealth Building Journey asks, how is flooding in and around Allegheny County?
Oh, so people think the rivers, like anything along the rivers in a flood zone, but it's not actually the case. Some of them are, but mostly it's just the creeks and streams that are kind of tributaries of the rivers themselves, because most of the stuff right along the river in Pittsburgh is industrial, like, because that's where all the steel mills and manufacturing and stuff were back in the day. So you don't really have housing right along the actual rivers in Pittsburgh. It's more commercial type stuff. So it's just a few specific neighborhoods that kind of are in flood zones as a whole. So like just to give examples, like I know Millvale's one, Etna, Sharpsburg, a good portion of those neighborhoods are in the flood zone. Coriopolis is another one, just one's off the top of my head, but that's where they're from streams and creeks, not the actual rivers. So it is important to kind of know where the flood zones are or aren't, just because you're gonna have to pay flood insurance if you're getting financing on a property in a flood zone, which some of the prices I've been seeing the last few years are pretty crazy with the flood zone properties. So it's knowing which is in a flood zone or not in a flood zone. So I always check it. Like if I'm looking at a property I know might be close to one of those creeks, just because doing this long enough, you start to pick up on which areas do have the flood zones or not. And then the other thing with the flood zones is like they tend to have a stigma to them when you're trying to sell them, not only because you have to pay for flood insurance, but like some of these areas actually do flood. Like Millville is an example that if we get a bad like hurricane remnants or something, like it will flood to the point where you're dealing with a claim on the flood insurance, destroys the furnace, destroys the hot water tank, stuff in the basement. If it gets up to the first level, we have to redo drywall and everything. So I think a combination of that plus the flood insurance costs, and you're kind of at the risk of flood insurance costs going up as well alongside regular insurance. So I'm not a huge fan of them, but like if you can also get in a neighborhood like say Millville, if you can get something out of the flood zone, you sometimes can take advantage of the fact that people might just assume it's in a flood zone, but if it's not, then you could like I like that neighborhood a lot. So that would be a good example of just knowing where the flood zone is or isn't and kind of taking advantage of that. Similar to the pocket neighborhood in a C class neighborhood type deal. So it's a lot of variables with the flood zones as well. But yeah, they are here in Pittsburgh, but they're not widespread like people might think. Having the three rivers going from downtown, basically thinking that everything along the river is in a flood zone, basically.
Let's see. Grumpy contractor REI Jim is here trying to make trouble. No, he's in California. He's a contractor for 30 years, but as you probably know too, California is super expensive, so it's hard to make deals work. But he wants to know because he's looking at other markets also, investing out of state. But he says, how is value add from a long distance investor that would like to fly out compared to someone involved specific, especially in the organization. Wait, someone involved that would like to fly out to someone involved scheduling in the organization scheduling wise. I guess from someone from a distance trying to coordinate value add stuff compared to someone who's in that area. I think this is what he's trying to say.
Yeah, I mean, the contractors that we work with and refer, they're kind of used to working with out of state clients at this point just because there are so many of them. So a lot of them have systems in place to kind of keep clients updated. They have systems to work with them on recommending materials for the rehabs to make it kind of more seamless rather than if you just had a contractor that was only used to working with local clients. It might be a little more hard for them on the communication side of things to cater to the out of state clients, especially contractors that aren't used to working with investors or investment properties. So same with that, just like any sort of team you're building out of state, it just has to be the right people, to the point where we have a lot of clients doing value add rehabs from out of state because they're using the people that we can recommend that are used to working in that environment with out of state investor clients. Basically, we have seen issues where like clients go to try to find their own contractors, say like off Facebook or Craigslist or something, and it can turn out bad, but that's it greatly reduces the risk when you're using kind of people that are used to it to begin with. But yeah, we have people doing that here. It's not as many new investors. I would say it's more kind of like after they get their first couple, then they get used to just being out of state, third party property management, then they're kind of get more of an appetite for jumping into rehabs and value add. I love value add. Like that's primarily what I do on the investing side when I buy properties. It's especially now where you can't really rely as much as you could on market appreciation previously. If you can do a value add and get equity right off the bat, it insulates your investment to kind of make it better long term. You don't have to worry about what the market itself is going to do because you're getting that equity right off the bat. So it's a good market for sure for value add because we have so many old homes and we're always seeing opportunities for fixer uppers. We just hope that our clients use the people that we recommend that are used to working with that.
Yeah, so Jim, Owe Nicholas, he is in the school community, but he's not as active in there, but he's someone you might want to message because he's been doing value add stuff, burr stuff with Jeremy from California. Hyder says, question, has anyone heard of an appraiser being rejected by a market because they were handing out bad numbers? Have you heard of that? I haven't heard of that. I'm sure it probably could happen, but um, I wouldn't think it's pretty common. That would be my take. I think that was a question we had too the other day. If do we see appraisers being um, taken over a job taken over by AI to some extent, right? Because you're just gonna
I'm
put
sure
in
a
comp.
lot of the white collar jobs to some degree, honestly. I think blue collar might be the way to go in the next decade here, but we'll see how that plays out.
Yeah. Andy says, yeah, I hope other cities don't jump on board with a stipulation like that, but wouldn't surprise. Columbus is really hammering on growth and new builds that could potentially run smaller investors out. Yeah. Sarah says, yeah, like tenants taking pipes out of the wall. So Sarah, I believe she invests in Savannah. But she great story in the military, her and the husband, and they basically use their VAs to leverage and acquire multiple properties, pay multiple ones down, and now she's
VA
trying.
loans are the golden goose.
Yeah, so but her fear was always I guess she grew up poor, maybe how you could say it, but she was always worried about losing the money. So she was more focused on paying down the properties. And I guess now she's in that phase of like, oh, how am I going to use all this equity? So now she's kind of trying to get out of her comfort zone of having these paid off properties and maybe figuring out how to leverage them to expand her portfolio or build more wealth for her family. Let's
Yeah, I
see.
like using leverage, especially at the beginning. As long as you are doing your due diligence and aren't being reckless with it, it's a great way to scale. And then once you've built kind of the number of units you want, reach that enough point, which that's kind of where I'm at now is deleveraging. I was very high loan to values at the beginning, whereas now my portfolio is maybe like 63% loan to value. So I'm okay with the stuff getting lower loan to value over time, but using leverage at the beginning to scale the portfolio as long as you're doing it smartly.
Joe V actually has a serious question for once, but Joe V does property management also in Wisconsin. So he's asking, what is the going rate for property management companies?
In Pittsburgh,
Yeah, probably. Yeah.
uh, generally you're going to be 10% of the monthly rent for the management fee, and then first month's rent is the leasing fee. And then a lot of the management companies will have miscellaneous fees as well. Like I know with Mace, they do, I think it's a $100 to $200 flat fee per year for lease renewals, and then $5 per unit technology fee for the software. So usually some sort of extra small fees the management companies do. And if you do have like a higher renting unit or a lot of units with the management company, generally they'll start to lower that 10%. Like say you have a single family house renting for 2500 in Shady Side or something. They're not going to charge 10% for that. You'll likely get lower like 5, 6, 7, I would have to imagine for something like that. And they're not going to keep the whole first month's rent to lease a property like that. So I would say if you get rents over about 1600, you probably have some leverage to negotiate those. Or once you get maybe about 10 or more units, you could probably get a lower management fee. Leasing fee, it more depends on the actual rent amount, but just with anything, you get efficiencies as you scale more, but 10% in first month's rent are kind of the general fees to start, I would say.
Yeah, that was kind of the topic we were talking about yesterday on the live, where some people are trying to simplify their portfolio, pay off properties or kind of take away some of the headaches. But as you kind of touched on, and Ned touched on yesterday also, was sometimes scaling actually simplifies your portfolio. Like you're saying, the more properties you have more leverage. You can get better property management rates, things like that. So actually, sometimes by scaling, even though maybe you're growing the portfolio, you're actually making it less headaches or more efficient because now you have more leverage to who you're working with, like the property managers, contractors. You can get better rates on projects or whatnot. So yeah, it was an interesting way Ned was looking at it. Let's see. So Chester's asking, since you're in Pittsburgh, is Jeremy is somewhat my boots in the ground, but I work with his boss in a sense, or who Jeremy's under. I work with Alex, but Alex is, as we're saying, Jeremy's 31. He's younger. Alex is on the older side, I would say. So I'm not sure when Alex is gonna exit or hand the keys over to someone else. But Alex is definitely on the older side, and like Jeremy, I think touched on the last live. He's owes a lot to Alex and how Alex and Ian helped him and grow and whatnot. So but yeah, definitely, I know I can call on Jeremy if I need anything. But there's a lot of guys in the community that, like I said, I don't know if they prefer working with Jeremy, but like I said, Alex is kind of maybe doesn't move his feet as quickly as Jeremy does because
What
he's
did you
kind of
refer to it as, the Yoda versus?
yeah, he's like Yoda. He's just kind of all right, I got this wisdom, and but definitely, I think Jeremy has a little more hustle in him. So I think maybe that's why Lars preferred to work with Jeremy, and that's why Harrison also. So yeah, but both of them are great connections, and if you want to get into the market, I highly recommend connecting with them. I'll put Jeremy's Instagram stuff on the chat also again, but it's also in the beginning of the chat. Let's see. Flavio said yes. The community is growing. We should get together and buy a whole street. So Flavio is in Grandview, Washington, and I believe he's starting to consider looking at investing out of state because even Grandview, Washington, is getting kind of priced out for investors.
That's
Um,
something I actually have debated here, is going into a cheap neighborhood and just literally buying the entire neighborhood and driving up the comps. One of
mm,
the local investors here, he's doing that in like Homestead Munhall area. He's
int-
literally making these things like crazy nice, just specific ones that he's doing like unique rehabs to, and he's selling those, but he's keeping most of them. So he's driving up the ARVs and then he's refinancing his rentals after he gets those new comps basically on the ones he sells. And you can do that in some neighborhoods here because some of these cheaper neighborhoods you can still buy fixer uppers for under 50 grand. So you could do decent volume with it, especially if it's a neighborhood that's kind of on the up and up. So it's definitely something I've considered doing, but it would be definitely a large undertaking, but it could be possible in cheap markets for sure.
So Chester is saying he misses seeing a lot of the comments because of the vertical format. So yeah, I'm not sure. I know the vertical format is supposedly being pushed out more on the algorithm because it's kind of like TikTok's competition, but I'm not sure. So for the time being, I've been doing vertical format, and it definitely makes it easier for me to edit the videos after. So that's kind of that's kind of why I like it. But we'll see. We'll see if I switch back. Jason's here, so morning, Jason. Buzztune is Mikey, so you know Mikey. Mikey also connects with Jeremy. Was working with some of Jeremy's team members until recently. Let's see. Lars is here. So Lars, did he close it? I know he got the all go on the sewer, right? When is
Yeah, we're just waiting on municipal stuff now, but yeah, that one looks like it's in the clear. Speaking of Homestead,
Yeah, so Lars is working. So Lars, if anyone doesn't know, was investing in Delaware up until recently. He pivoted towards Pittsburgh, and he's working with Jeremy, and they have duplex, triplex,
duplex.
duplex. They're under contract and just got their the sewer scope all clear. And then there is Jeremy's two Instagram pages right now. So go check him out. Go follow him if you want to know more about Pittsburgh. Go connect with him. Yeah, Lars said that's an awesome strategy. I think he's thinking what you were saying about buying the whole street.
Lars might buy the whole neighborhood.
So Joe V hates vertical, so I'm going to stick with the vertical then. If Joe V doesn't like it, Chester is saying, how much demand is there for affordable rentals? Do you have any Section 8 in your portfolio?
I don't personally. I had one inherited Section 8 tenant, but I just don't because I more so view it as a way to get above market rents in some areas, but you're dealing with Section 8 can be a hassle with like their inspections and paperwork and delays to get paid and all that. So it's a way it's kind of similar to like if you want to do rent by the room or mid or short term rental. It's a way that you can drive more cash flow if you can get into a neighborhood that has Section 8 rents that they'll pay that are above market rents, but it's going to be a little more work involved. Not nearly as much as like a short term rental or rent by the room, but you do have a little more red tape with them. But yeah, it's a lot of demand for the cheaper neighborhoods in Pittsburgh. I think just because you have a lot of like blue collar service type workers that anytime you list a rental in a cheaper neighborhood, you're going to get blown up with inquiries and showings. It's just a matter of finding qualified tenants once you get kind of in too rough of a neighborhood or too far from the major job centers. Then it just becomes finding people that can qualify and meet your standards basically for the rentals. So it's kind of a balancing act. I think it can be a good strategy for sure if you're in neighborhoods that are close to the major job centers, just knowing that it might be a little more work involved, but it's definitely a way that you can drive more cash flow because there is a lot of demand for it in the Pittsburgh area, being kind of a more affordable city in general.
Where was it? Uh, Professor Oak says, "Is Jeremy a Bitcoin believer?"
I do not have any Bitcoin. If I was maybe if I was at a different uh in my journey, like if I was more at the beginning, I would get a little bit of exposure to Bitcoin. But for me at this point, like I'm kind of already just riding the wave with the assets that I've built. That doesn't really make sense for me, in my opinion, to add non proven assets, I guess, higher risk assets, especially because I'm kind of deleveraging with the real estate portfolio. But I think it could be something that like younger people maybe get a little bit of exposure to just because it probably does have higher upside, but it has higher risk as well. Like I'm not really looking to add higher risk investments. Some people might not think it's higher risk, but I don't know. That's just my thoughts is it's newer, so I would think that it's kind of higher risk from that standpoint. So I don't have any. It's just all real estate rentals. I do some private lending as well, so I have some notes, and then I do have index funds, but I'm kind of getting out of those, I think, as time goes on to do more lending as far as in addition to the rentals that I have.
Yep. Anything is risky if you don't know enough about it, right? I mean,
Yeah, and I don't know anything about it either.
yeah,
I
yeah.
haven't spent the time to learn about it just because I don't know. The way I see it, I'm in the business here in real estate every single day, hitting the streets, knowing the areas on rental properties. I think that's, in my opinion, the equivalent of insider trading in the stock market. Why would I not just focus on that instead of getting into stuff that I don't know anything about? That's another reason why I think real estate in Pittsburgh here for me, given kind of I'm so in the business, it's very, very low risk adjusted. It's a very high risk adjusted return because it's greatly reduces the risk being in it like I am on a daily basis. So that's kind of my philosophy on it.
Do you know Lindsay Stamp? She's on X. She's in Pittsburgh. She's a well, I don't know
Yeah,
if
yeah, yeah.
so. Yeah, she
She
was.
she she started tweeting more about Bitcoin,
Oh,
right?
yeah, she is
She
gone.
dove
And
into it.
yeah, so I believe I know she might have sold some of her real estate. I mean, she didn't have a big portfolio. She had a small portfolio, but initially on X, that was kind of her talking. She spoke a lot about real estate stuff, and then now, yeah, it's really gone to Bitcoin. I wouldn't say crypto. I would just say Bitcoin mainly. She talks about, but even her, she's been weighing like, oh, do I even want really anymore? But yeah, it's interesting. But yeah, there's multiple ways to build wealth, but definitely get educated on it. Hyder says vertical sucks when swiping up. The video gets changed all the time. Um, do you, Hyder, I'm not sure. Do you mean like people's position on the screen changes? Because I'm actually doing that a lot of times because I'm trying to put whoever is speaking. If there's more than two people, if there's like three people or four, I try to put whoever is speaking in the middle. But that's yeah. But I don't know where Harrison is too. Harrison was supposed to be here, but I believe they're downsizing at work, so he has more work on his plate right now. Um, let's see. Oh, Dennis is back because I saw him pop up on the Instagram side, but he's back here on YouTube. He says, "Do you work with any local lenders that will provide bridge loans for a Burr strategy?"
Yeah, there's some lenders here, mostly brokers, but we do have access to short-term funds and local hard money lenders, hard money, private money. There's a few local guys that lend on deals that between them and the couple brokers that are local here, that's probably who most of our clients are using for the short-term loans as far as the value add type stuff and then refinance out after. I tend to prefer the local lenders just because some of the national lenders have a lot of red tape and we've seen instances where they back out of deals at the last second or they make it very hard with they'll still send an appraiser out, so they'll still require a bunch of documentation and stuff to the point where I think it's a lot easier to work with the local guys on the short-term lending side of things.
So Chester wants to know about property taxes in Allegheny County. I think that's the one thing that kind of catches people by surprise.
It's all across the board, so that also goes back to knowing which areas are higher property tax areas than others. Like the city of Pittsburgh here, it's the lowest property tax millage rate in Allegheny County. It's people might think it's the highest, but in terms of property taxes you pay on the buildings, it's the lowest. Whereas like as you get outside the city, some areas can be low, some areas can be high. So where we see people run into issues is areas like Bellevue, Brentwood, Avalon, Wilkinsburg. These areas are very, very high millage rates, and they keep an eye on properties that sell. As soon as those things sell, for if they see, say, the assessed value is 50% of what it sold at, they're going to go in and appeal the taxes. And sometimes we're seeing taxes double, sometimes triple, quadruple in these areas because people are assuming they're going to stay the same. And that's where they can get burned. So it's really a matter of knowing what the millage rates are for the specific areas and knowing what they're currently assessed at. And that's where, like, if we're helping a client buy a property and we see a big gap in that, or it's a higher tax area, we'll let them know, like, look, this thing might triple, so you want to make sure you're aware of this in that instance. Whereas, like, we're seeing a lot of these properties sell multiple times within the last 6 years because every time they've bought for more, they've reassessed it and the taxes went up. I'm seeing some of them that were like, the taxes were like $2,000 a year, say in 2019, and now they're selling again this year and they're like up to 10 grand. So that, especially when cash flow is tight to begin with, if you run into a situation like that, you can really get burned. So it's just knowing what specific area millage rates are, and they're really all across the board here in the Pittsburgh area for sure.
Hyder recommend. He says read the Bitcoin white paper and get off zero. Bitcoin is not conventional, and the risk isn't conventional either. Yeah. Yeah, I definitely. I mean, I think Bitcoin definitely has a purpose. You know, the blockchain. I think, but I think a lot of people are definitely like Hyder probably would confirm. It's not crypto he's into. He's into Bitcoin. So he's kind of focused on one specific thing. So, but there's a lot of people that are just jumping into crypto in general, and in a lot of different let's see. Oh, I didn't even know. Are you secretly doing other podcasts? See, BuzzTune says, "How was your experience with the Millionaires Unveiled podcast? Great interview." So, what is that all about?
The one I did with them?
Yeah.
Yeah, it was good. I like their podcast. They dive deep into kind of people's wealth building journeys, what they invest in, um, their philosophy on things, kind of how they made their money. So it's definitely a podcast I like. I don't think it's like super well known, like compared to
Well,
some others, but yeah.
well, Mikey, if you have the link, you can always put it in the chat so people can go check it out. Um, let's see. Sarah agrees with you, Jeremy. My real estate is stable and proven. I'll keep minding my business with real estate. Hyder said, in my opinion, too many do not know why they need Bitcoin. The risk is in not knowing why or why not to own it. Yeah. Closing costs, Chester says. Also, how are closing costs? Also, is there much multifamily in Pittsburgh?
We have a good supply of multifamily, which I think a lot of people like. I like it. Most of my portfolio is multifamily. So it's definitely a popular investment here for sure. And there's a steady supply of them. Like, we're always seeing pretty good deals on it. So definitely prefer that for long-term buy and hold over single family if you're just buying something turnkey or close to turnkey. Um, what was the other one? The other question of that?
Closing costs, like roughly. I
Okay.
mean,
That can vary a lot as well, kind of with the property tax thing. So the city of Pittsburgh, the big thing is the transfer tax, which, Mark, I'm sure you're aware of this,
yeah, I
but
talk about it all the time.
the transfer tax in the city limits, if you're buying something in the city of Pittsburgh, is 2.5% of the purchase price per side. So if you're buying a fourplex, say 400,000, you're paying as a closing cost 2.5% of that at closing. And usually the buyer and seller will split it in a regular transaction. So that's something to keep in mind. If you go outside the city limits, most of those neighborhoods are just 2% total, 1% of the purchase price per side. So if you didn't know the city was 2.5, you were thinking it was 1% like everywhere else, you could be surprised by that when you get your cost sheet going to closing, like, oh crap, it's on this 400,000, I could have been paying 4 grand, but now it's 2.5%, I'm paying 10 grand on this thing. So knowing that as a big cost. Outside of that, like, that's the big one. Everything else is just kind of standard, like your title fees, lender fees. If you're using financing, generally they're going to want you to pay a year of taxes and insurance up front for the escrow. But that's kind of the main thing to be aware of in the Pittsburgh area is the transfer tax. In addition to those, it's a Pennsylvania thing, but each municipality has their own rates for transfer tax, Whereas like some of our out-of-state clients that are in areas that don't have transfer tax, they aren't aware of it. So we make sure people know that it is a thing whenever they're going to be closing on a place and they're not surprised by it. So same thing with everything else. It's knowing the areas, knowing the differences of the different areas when it comes to insurance, closing costs, quality of the individual neighborhoods, etc.
Yeah, that's the one thing, like you said, it always comes back to just knowing your market, knowing people that are doing it already, so they can help you with those little nuances, right? Like just like someone, if they wanted to get into the Texas market or something, then they have to realize that insurance, property tax, have snuck up on newer investors. So if you're working with someone that's already been in that market, they can help you along. Like, hey, realize that your costs are going to be this probably after year one, because your property taxes are going to be reassessed and things like that. Chester also mentions, I guess for fixer uppers, he's hearing property taxes doubling, and I guess that was to your point of certain boroughs are monitoring sales and things like that, right? So like if you buy a fixer upper, would refinancing come into play there? So like if you burr it now, you refinance it, is it gonna assess the tax value right there?
We're not that sophisticated here yet. So it's normally just the purchase prices on the new sales. So it can be an advantage if you are buying something that needs a major rehab. Your cost purchase of it is pretty low. That's why, like, especially on wholesale deals, the purchase price is actually what the wholesaler had it under contract with the seller at, as far as what's recorded. So those are really low, to the point where you're probably not going to get a tax reassessment. If anything, you might be able to appeal the taxes because the purchase price might be lower than it's assessed at now. So it's that kind of works in the opposite way. They're really just kind of reactive with this type of stuff. Like they're not looking farther into it. At least in my experience, from what I've seen, it's they're not looking into the actual loan amounts and everything. The one thing too was some of these counties outside of Allegheny have done full-on reassessments of the whole county, every single property. This just happened in Beaver County last year, and then Washington County, I think, was like 5 or 6 years prior to that. But the state basically forced them to do a whole full-on reassessment of every single property up to present day. So they reassessed all of them, and the taxes changed on those properties. So that was kind of like a curveball for some, that their taxes changed quite a bit as a result of that. And I think at some point, probably Allegheny County is going to do it, but they just haven't done it because it's costs a lot of money, especially when you're dealing with a more densely populated county like Allegheny, where the city's located. So that's kind of how it's worked, whether you're in Allegheny or outside Allegheny, basically, is just knowing that as well. Like I've seen some of the ones in Beaver County that previously, prior to that reassessment, they were at like 3,000 and they came in and now they're 10 grand. So we're seeing people list those on the market because they're no longer cash flow positive after the reassessment. Just from the that it went from a positive cash flow investment to a negative one from no fault of their own, basically.
Hyder says the reason I own Bitcoin is because I own it. It's mine, not a liability of the Federal Reserve. Federal Reserve notes can be manipulated very easily by their masters, the Fed. Bitcoin is controlled by computer code that has been distributed all over the world and must be in agreement for cash transaction. Yeah. I think that's why a lot of people do like Bitcoin, and that is their preferred asset that they're investing in. Lars, who we said is closing on a duplex with Jeremy, he says the amount of small multifamily in areas of Pittsburgh that you won't get shot at for looking the property after 5 p.m. is a big reason why I chose Pittsburgh. Chester saying Beaver County is State College, Penn State.
No, Penn State's in the middle of the state. We're Western PA, but there is a Penn State branch in Beaver County.
Mikey Buzztune says, any luck submetering or splitting utilities on small multifamilies? worth the cost or difficult with the age of properties?
So there's a lot of variables involved with that. Um, I like to at least have gas and electric split on any multis that I own. So I would highly consider it if those weren't split. The easiest to that being kind of, say you have a shared gas meter, but you do have two electric meters. You could do something like I have a duplex like this. The first floor made it all forced air. The furnace heated the first floor unit, and then you cut off the ductwork to the second floor. You make all the appliances and the hot water tank electric, and then just make that electric either heat, or if you want to do mini splits, you can have heating and cooling. So then the tenants are both paying their electric, lighting, and heating basically to the point where you're only paying water. So that's electric's probably the easiest route to go, most cost efficient, but highest benefit because you can get them paying their own heat basically. And a lot of times we're seeing they do have separate electric meters, but maybe like a shared boiler or something in some of these multifamilies. So that's where I think it can make sense if it's something like easy like that. But if you're getting into like splitting gas meters, that can be a lot of money to the point where it probably won't be worth it with the price point here, to the unless it's like a higher end area. But most of the ones that have like, say, one shared boiler for the whole building, they're mostly in C class areas. So generally it doesn't make sense. On water, that can depend on how the building's set up. Like if it's a side by side, that's a lot easier to split the water than a converted mansion that's sectioned off into five different apartments. So like I might consider it on the side by side, but probably wouldn't consider it on the other one just because of the complexity of where the water lines run. So that's kind of how I would view that. I would say it doesn't happen a ton, but if it's an easy plug and play, it's probably worth it. But if not, then I think it's just a matter of, if you can, at least buy stuff with gas and electric split. The water is not as big of a deal in my opinion because most of them bill, instead of like they bill on actual usage, but it's tiered to the point where even if you use a lot of water, it's never really catching you by crazy surprise. Basically, it's very hard to abuse the water compared to the heating or the lighting, just because of how most of them bill the water bills.
All right, great breakdown. Yeah, I think that's the one thing too. People, if they are gonna consider investing in Pittsburgh, is just, realizing or getting comfortable that there is a lot of older homes there, and I think that's the one either reason people don't want to go there, or they just got to get comfortable with that fact. I think that's the biggest thing, is just there is a lot of older homes in the area or in that market.
Yeah, and I
Um,
think that comes down to just being conservative with the capex and maintenance when you're running the numbers. Like somebody comes in and tells me like, "Oh, I'm using 5% for maintenance and capex, but this is a building built in 1900. It's a multifamily that was a converted big single family house at one point." Like I'm going to tell them they need to factor more than that. Like 5% on a that type of building versus 5% on, say, a side by side duplex built in the 80s. It's a lot different when it comes to that. So I think that's also where people can kind of go wrong, is if they're using cookie cutter expense numbers, not factoring in the age of the property and the mechanicals and everything.
Built in the 80s. Was anything built in I don't know if I've ever seen anything on the MLS built in 1980s.
I got one last year, duplex in McCandless. It was built in the 70s.
Oh, see, 70s, but not 80s.
You see more 60s and 70s. Like we
Yeah.
have a few of them that are 70s. Some of them are 80s or newer. Those are more like if they own the land and they just happen to do a new build duplex or something.
Chester, just to reference, he's got his first out of state property in Detroit. But he says, how are handyman general contractor prices there, affordable or on the higher end because of the age of the housing stock?
I think labor's fairly affordable, in my opinion, from what I've been seeing, like maybe on social media from other markets and whatnot. But yeah, the actual total cost of the rehabs, some of them can get really high, just the amount of work needed. Like if you're doing a gut job here on a 2,000 square foot house, that can get up to like 150, sometimes even 200,000 total on those types of deals. Whereas like if you're doing more cosmetic, it's more probably closer to like 30, 40, 50,000. So it's a wide range. That's where also just knowing kind of what stuff costs in general, it where you're falling in that range. But I don't think it's crazy, I guess, in my opinion, as far as like labor costs and everything. Just I think because everything's generally a little more affordable in Pittsburgh. Probably
Yeah.
similar to Detroit, I would have to imagine as well.
Well, so that was like the eye-opening thing for me too, and I think it's just coming from Hawaii and everything being more expensive, just even getting work done. Maybe it's not cheaper in a sense, cost-wise, like you're saying, but just from my experience of paying for something to be done in Hawaii, initially I'm like, man, is this? I wasn't factoring in the cost where it'd be so much lower over there. So that was kind of eye opening to me. So just you always gotta make sure you're kind of looking at it from the market you're in, because sometimes maybe I'm just like, oh, it seems cheap, but that's just it could be expensive for Pittsburgh, but because I'm comparing it to Hawaii, I'm like, oh yeah, I'll pay for it because it's
Yeah,
so. Um,
it's about
just
perspective, I think.
yeah.
And the same thing with like if you get in like an owner occupant in like $1 million house versus an investor or something, it's there's a lot of variability with it. But in general, I would say that the same job here compared to a market like Hawaii, it's going to be cheaper here. But if you do have a higher likelihood of the total cost on something being higher here because we have more dilapidated houses than maybe like somewhere in California or Hawaii would have. So just knowing how the extent of the actual rehab itself.
Yeah. All great points. Any more questions? Anything else you want to chat? You want to recap the Steelers draft or anything, or what else you're working on? When's your first YouTube video coming? I know you said you're trying to build that channel up now, so you got some videos in
Yeah,
the pipeline.
I've been recording some longer form. I think just Pittsburgh specific stuff. So, like, I've been doing some neighborhood deep dives, just general overview on the Pittsburgh market, different sections of the city, kind of how the neighborhoods are, where they're priced at. So, I think that'll be helpful for a lot of people looking into the market or investing here in general. So, probably going to cater it more towards like Pittsburgh specific real estate investing is what I'm thinking, but definitely going to start rolling that out here soon and doing some long form type content, and maybe we'll do some lives on my channel at some point
Oh,
once I get that
absolutely.
set up.
Yeah, absolutely. So anyone out there, when once he gets it going, we got to get him some 50 count subscribers so he can do live streams. It looks like Brian is tuning in. So if anyone was here from the beginning, Brian is the one that had the zoning issue and is closing on the fourplex soon,
We
I
were
hope.
talking about them.
Yeah, we were talking about you, Brian. I think that's why you heard your ears are ringing. But I'm glad that that's moving forward. You found a different lender and are able to move forward on that property. Sarah says, yes, I have that issue from living all over the world. Going from Hawaii, Seattle made me think everything is cheap. Yeah, perspective. I think definitely, that's the one thing. Troy is here. He said, the hardest thing I find owning out of state is having a contractor that understands your level of expectations and how things are to be done. Yep. So is that something you notice with dealing with a lot of different out of state clients? Maybe they all have different expectations.
Yeah, and I try to set the tone to that at the beginning just so people kind of know what is realistic or not realistic, not only from like the price point side of things, the return side of things, the management side of things. It's aligning expectations with reality, I think, prevents a lot of mistakes and just better communication overall. So I think it's just like making sure that those match up and people are aware of intricacies of how things work, especially being out of state. So I think that's a big thing that over time, especially, I've learned to make people aware of that will be very helpful for them investing from out of state, basically.
Yeah, like you touched on, I think the older homes and even their capex expectations, right? So that's just something people have to keep in mind, and then not having this expectation, because like Hawaii, I mean, I have expenses, maintenance stuff, but definitely not as much as maintenance expenses that come up in Pittsburgh. So, people that do start investing out of state, those are things that they have to be aware of. And to Troy's point, I think for me, that's what I always tell people that are looking at investing out of state is sometimes it's not for you. You really have to know your personality, right? Like, investing remotely and giving up a lot of control is some people just can't do it. So sometimes you may have
Yeah.
to invest in your backyard, even though your returns might be smaller. But knowing that the property is there for you to maybe drive 30 minutes to see, or be able to work on it yourself. And those are things you have to understand yourself. Let's
Yeah,
see.
the personality type's a big one. And you almost working on the agent side, you almost become kind of a psychologist in a way because you see so many different personality types like doing the concept of out of state investment that I completely agree with you that you has to be a fit for your how you operate and your personality and everything for sure.
Mikey's planning to go in September. He says, "Let's go." I don't know. I just looking right now. Do the Bears play the Steelers this? They do. Oh, but we play in Chicago.
Mm.
That should be a win. So we got one win for sure.
Kick us while we're down, huh?
Hyder says, as a contractor, I find that my standards have to be higher than the investor homeowner to make sure I meet those standards. This mindset should not be unique in the trades. Yeah. Troy asks, how would you suggest someone that is getting started to set that alignment with hiring contractors to do the work on the properties you're buying and renovating?
For me with contractors, like I try to set the tone at the beginning as far as what I'm expecting. I'll send a full scope of work, very detailed to the contractor to make sure that we're both on the same page as far as what I want done to the property and making sure that everything is accounted for. Because when I ran into issues at the beginning with contractors was kind of relying on them to do the scope of work and maybe missing out on some of the finer detailed type things that ended up becoming added on to the budget as the project went on. So kind of setting that tone from the beginning is what I've found works, and just making sure everyone's on the same page when it comes to the rehab in general as far as budget and timeline and everything. So that's kind of how I've done it with contractors, but like it's a little bit different for me at this point because I've worked with the same guys for a while. So I'm not really feeling out new ones as much, but that's just kind of it takes time to get to that point. But for out of state investment, it's a little bit different because you're kind of piggybacking off of the guys that we've built relationships with already. So it's kind of like we set the standard, the process in place, and they're just basically doing the same with our clients as they do for me and the guys on my team and whatnot. So
Yeah, it looks like we're getting some crypto bots popping in, but if you are, I hope bots can subscribe also. So just hit that subscribe and like button while you're here. Lars says Penguin games don't start until October, so he's hoping Mikey decides to come in October instead of September. Hyder says Troy communication. Tell them you want all traces of previous tenants erased or whatever the job requires. Yeah. And Chester says, "Yeah, be super minute in the detail." Hyder, I'm just playing, man. Thanks for always tuning in and moderating things and keeping all the riffraff down. But yeah, this was a good one. I think people are looking for other markets to invest in. They're looking for places that cash flow and make a lot of sense. And like you touched on earlier, too, piggybacking off of other people's systems. And we have a lot of people investing in Pittsburgh in our community, and now they're getting to meet people like you who are the actual faces of who we're working with or people that we're connecting with in those areas. So, like I said, if anyone is interested, go check out Jeremy's Instagram page. He's been talking about some specific markets on his page, some clips. So if you want to know more, go check it out. Go follow him. Be on the lookout for his YouTube channel. And we'll do this again. And thanks for everyone for tuning in. Have a great weekend. And I'll see you folks next week. Thanks, man.
Yep. See ya.